Real estate has long been thought of as one of the safest and best investments, as it offers the potential for steady income, tax advantages through depreciation, property value appreciation, and also leverage. But with all these considered, how did things go so drastically wrong in 2008? When the dot-com bubble popped in March of 2000, the S&P 500 and Nasdaq Composite fell into a massive bear market. The decline worsened after the September 11th terrorist attacks. In an effort to stimulate the economy, the Federal Reserve lowered interest rates. While this was intended to stimulate the economy and promote borrowing, it also meant investors would receive lower yields on other vehicles such as CDs, bonds, and on savings accounts. With confidence in the stock market shattered and banks offering low yields on savings accounts, investment banks were looking for new ways to secure higher returns. For lenders who issue mortgages, the steady cash flow received each month can be similar to that of bonds. The risk, of course, would be that the borrower would default on their loans. However, since housing prices were rising during this period, this was not much of a concern. After all, properties could always be sold for higher prices. This was all based on the assumption that housing prices would continue to rise. Lenders and investment banks came up with a great plan. Investment banks would buy the mortgages from lenders. The lender would still collect fees from borrowers for initiating the loan, but would then sell the mortgage to investment banks. Lenders could then go and loan that money to someone else who was looking to purchase a home, while investment banks would now receive steady monthly income payments. As investment banks began buying up mortgages, they came up with a method to package them to investors. All of these mortgages were bundled together as mortgage-backed securities, which would provide investors with a steady flow of income. They weren't viewed as risky, since even if the borrower were to default, the house could always be flipped for a profit, since real estate prices had a consistent track record of rising. Wall Street loved these mortgage-backed securities, since they provided reliable cash flow with seemingly very little risk. And they were constantly looking for ways to buy more and more of these mortgages, which they could then package together as securities. Insurance companies also wanted to get in on the action, and did so through credit default swaps. Basically, in return for a fee, insurance companies would pay out should the borrower default. Insurers began selling many of these credit default swaps, since they believed real estate was an incredibly safe bet. For a premium, companies like AIG insured the payment of these loans. Insurance companies had nothing to worry about as long as real estate prices did not collapse. At this point, everyone was making big money off the real estate market. But there was one problem. Lenders were starting to run out of people to give mortgages to. Typically, lenders use metrics such as credit ratings, job stability, or debt-to-income ratio to identify if someone qualifies for a mortgage. However, without many prime candidates left, lenders started to issue mortgages to subprime mortgage applicants. These were people with poor credit scores, varied work experience, or those who had already a large amount of debt. Lenders weren't worried though, since the real estate market was so hot that even if the borrower were to default on the house, it could easily be sold for a profit. Many subprime mortgage borrowers actually received predatory loans, but these were spun off by politicians as a wonderful breakthrough, allowing more citizens to achieve the American dream of owning their first home. All the mortgage-backed securities that were issued needed to be graded by credit agencies like Moody's, S&P, or Fitch. What is important to note is that the highest-rated investments are deemed investment grade and thus eligible to be purchased by large pensions, mutual funds, and institutions, which all have billions of dollars to invest. But what about all those subprime mortgages? Wouldn't they be graded poorly by the credit agencies? Investment banks knew subprime mortgages would receive a poor rating due to their risk, so they decided to package them together with other mortgages. Imagine there was a huge box, and in that box we throw in some mortgages that are likely to not default. These AAA graded mortgages are deemed investment grade. Then we throw in some BBB graded mortgages, which have some borrowers that have riskier characteristics. Finally, we throw in the subprime mortgages, which had a higher chance of defaulting. All of these mortgages are grouped together as a CDO, or collateralized debt obligation. Because only some of the mortgages were risky, the idea was that the higher graded mortgages would pull the grade of the entire investment up. The reasoning was that a CDO would be divided into three groups: the senior, the mezzanine, and the equity group. The seniors group, which had the less riskier mortgages, would be paid first, and the equity group, which had the riskiest mortgages, would only get paid after the senior and mezzanine groups were paid. The CDOs were set up in this way to make the investments seem less risky. Credit agencies like Moody's knew there was risk to the CDOs. However, they felt pressure to give them an investment grade rating. Their thought process was simple. If Moody's gave the CDOs a poor rating, they feared investment banks like Goldman Sachs would move their business to another agency. By giving the CDOs a AAA rating, they were ensuring future business with investment banks. All of this was going well until 2007, when some of the subprime mortgage buyers started to default. As more and more borrowers started to default, an influx of houses started to appear on the market. As the supply of homes on the market increased, prices started to fall. As prices dropped, many of those who had recently purchased property decided to intentionally default on their mortgages, reasoning there was no point in paying a huge monthly payment for a house that was no longer worth the price they paid for it only a year or so earlier. Thus began a very dangerous domino effect. Everything we've spoken about thus far was based on the assumption that housing prices would continue to rise, and that assumption began to unravel in 2008 as the real estate market started to fall. Pension funds and investment banks that owned the CDOs began to get worried that these investments were not the safe bets they thought they once were. Insurers began to realize there was no way they could pay out all of their obligations should borrowers continue to default on their mortgages. On September 15, 2008, panic hit Wall Street as Lehman Brothers filed for bankruptcy. This sent the market into chaos, with the Nasdaq down 3.6%, the S&P 500 down 4.7%, and the Dow Jones Industrial Average off 500 points, or 4.4%. The Federal Reserve offered to make emergency loans to banks. TARP, or the Troubled Asset Relief Program, offered bailouts to banks. $250 billion was spent to help shore up the banking system, automakers, AIG, and homeowners. In January of 2009, Congress passed a stimulus package to help revive the economy. The S&P 500 would fall over 50% from its high in 2007 to its bottom in March of 2009. In 2010, Congress passed the Dodd-Frank law. This financial reform was enacted to prevent banks from taking on so much risk. It also reduced predatory lending and provided other safeguards to prevent future banking crises. I think the big takeaway from the Great Recession is the dangers of excessive greed and the perils of relying on false assumptions that trending markets will continue to trend forever. Whether you invest in stocks, crypto, or real estate, it is important to remember that every boom ultimately ends in a bust. While this seems like an incredibly obvious statement, for those caught up in a mania of a raging market, it is something that's often seen as a problem of the past, or a memory of a bygone era by those who just don't realize this time it's different. Sadly, as long as greed is part of the human psyche, booms and busts will continue to happen and will never be confined solely to 2008.